side, like you said, EBITDA, so any guidance can you give, because our EBITDA was lower in this quarter. Any ballpark number that you feel? Yeah.
Yeah. No, actually, as I told you that absolutely we are not putting in any number in terms of the guidance. But what happens is that if you look through last year, we have been at about 14% order. This year we have sustained that, and we will sustain, because if you look at 9 months, we have been there at about 14.2%, and we'll sustain. And this quarter specifically, a blip is on account of some settlements on the legal side, which I said will not get repeated out or whatever it is, because we're taking a lot of cautious measures. So if you look through for the year end or whatever it is, wishful thinking is to increase at least by about 150 basis points to 200 points. But I think we are at least bare minimum, we are confident that we'll be able to increase by about 150 basis points in the coming years. Yeah.
Okay. Thank you, sir. Thank you so much. Appreciate this. Thank you.
Yeah.
Thank you. We have our next question from the line of Aditya Zawal from J&J Capital. Please go ahead.
Yeah. Thanks for the opportunity. I have two questions. The first one is related to expenses. I see our expenses are we have added a good headcount from last year to this year, but I see the revenue growth is not showing up in the results. So regarding that, I need some clarity on that. And the second part is on the digital engineering business. I know our company core competency is in the testing and digital assurance or quality testing or engineering. But why are we going with the development focus? Do we have the right talent and skill set in that area to explore? And that is my second question. Yeah.
Okay. I'll ask the second question to get answered by my Chief Delivery Officer. On the point number one, basically, is that while the addition of manpower has come through in the current year at a cost, as you rightly said, we should look at that 12% of the business. We have given an increased threat and created a bench for the purpose of digital engineering purposes, which comes at a differential cost. These are investments in the business which necessitates basically cutting down a little bit on the margin side to absorb, and we don't carry out of any expenditure as a capital asset. So invariably we'll have to invest, take it, and then we have also invested a little bit on the R&D side, which was necessitated to get through in terms of if you have observed the company's website or whatever it is that we have come out with certain IPs and then which are successful, and then we have started even selling on those licenses. So this was necessitated, and it's a cycle in the business which you'll have to do it, and especially when the transitioning and transformation happens. So that we can't, while the business is linear, I won't be able to bill everyone back into the business in terms of the billability. And we will have to invest, think ahead, invest, and start moving ahead, basically, and start realizing at a point of time very clearly. So this year has been a year of transformation in terms of the digital, which necessitated for me to spend on the offering side, center of excellence, creating a bench pool so that the customer gets confidence, internal sales gets confidence, internal delivery gets confidence that, yes, the resources are available for deployment and taking over so that it becomes a big bang theory. That is on question one. Question two, with respect to the development and offerings, I request Raghu to answer that, actually.
Thanks, Krishnan. I think while we were always, as you rightly said, initially we were a testing, quality engineering, quality assurance, or digital assurance company. You would appreciate that finally we were responsible for quality of development of the product, right? And quality of their release, quality of their deployment, quality of how their production worked, anything and everything related to quality. That is point number one. Second, we as a company have always adopted technology as a means to drive testing as well. It is not just functional testing with manual eyeballing, right? A lot of tools, a lot of technologies, a lot of people with development background, and our core offering has also been around test automation since quite some time. And test automation is about writing code to test code. Therefore, as a company, we also realized, and this was just before pandemic, and that's where we started pivoting towards digital engineering services as well, is that if you want to continue to influence quality across the software development life cycle And with the advent of Agile, with the advent of DevOps, as more and more testing and dev getting integrated and congruently working in the context of SDLC, it becomes important for us to influence quality across the life cycle. And it's no more just that you know only testing techniques or testing technology to drive quality, but you have to be able to influence across the software development life cycle with quality at the core. Because we had that expertise at the back end, we had the skill set of driving code with code in terms of quality testing and ability to have a seat in the digital table to make that quality pivot for the enterprise in the context of the overall SDLC. We started expanding our service offerings into a larger realm of digital. And we didn't do this only unanimously. When we discussed this with our clients, we piloted some of our offerings with our clients, our capability to go above and beyond to be able to handle digital applications and drive quality. We were very much welcomed. It is a logical extension to move from just testing to influencing quality across the SDLC by also contributing into digital engineering, therefore helping digital transformational goals to be achieved by the enterprises.
Okay. But how much of our headcount is into development? Because I think the last time it was at 100 par. It is increased, or how is that number?
Yeah. As of last month, we stand somewhere between 500 to 600. The reason why I say 500 to 600 is because it's a flux anyway across globe. But today our development practice is close to about 500, 600 people.
Okay. And on the expenses part, I understand that we are doing R&D and we are expensing out. That is great. But I was particularly asking about the employee expenses. What is the current stance in our hiring? Are we having the same space? Because a lot of I see from last year also we have hired a couple of extensive hiring we have done. So when that will be sweat and come to our growth? That is what I'm trying to understand.
See, I made very clear that it's a year of investment, and we are conscious very clearly that we have done only utilization of 70% on the digital engineering side, whatever is done basically to build the resource pool for purpose of deployment, which is getting now converted. We are cautiously optimistic in terms of trying to get the money value of all the investments which we are trying to do on the digital side clearly. So if you look at the investments, the entire investments on the resources, we are now trying to recorrect the entire pyramid structure both on the existing business and also on the digital side, which should see benefits in the coming quarters, especially in the coming year, first 2 quarters. Yeah.
So we have, whatever we have hired, it was mostly towards development role. Is my understanding correct? Whatever the last year.
It's a combination basically. Some of the key accounts just come on the retail side or whatever it is, demanded a better skill set in terms of technology, domain knowledge and domain expertise needed very clearly. So which has come as a lateral hire, which even out over the project period, because these are projects which are for a 5-year contract, 3-year contract which is coming through, which will even out over a period of time. And also the advantage when we try to build a domain and get the domain expertise is that the investments is multi-fold, because subsequent projects we don't need to invest again in the domain expertise. It gets evened out completely and Jumpstart becomes comfortable. So it's a part of the business. We'll have to live with that very clearly.
Okay. Last, I have this question.
And then even if you go through the employee cost for 9 months comparison to 9 months, while I may have incurred 14% on the employee cost, I have come down on the contractor cost by about 7%. Overall. So the net part of it, if you look at it basically, is that which is in parlance with the necessity for the business, which with all these investments coming through, I've been trying to do the optimization best possible within the short time. Yeah. Please go ahead.
I understand. Yeah. So I understand digital engineering, we are spending a lot of efforts there, but our major part of the revenue comes from digital assurance. And how confident are you in this space for the next year? How do you see the growth in the digital assurance?
I think I think I will ask my colleague Sairam to talk about the marketing value. Sai, can you just provide the market value of the digital assurance and market value of digital engineering just as a one-liner, so that's the confidence and space at which we are tapping, right?
The overall integrated digital engineering and digital assurance market right now is about $705 billion and expected to be about $1.3 trillion. That constitutes both digital assurance and digital engineering. And as I said in my commentary, the digital assurance market itself is getting an additional 2.5% growth to about $23.5 billion owing to the impact of generative AI, and the overall assurance market is $43 billion. So if you look at it like a 3-point agenda, we have increased our total addressable and serviceable market by about 15 times, and with an integrated portfolio that we are building, and as reflected in our GTM strategy, with the set of accounts that we are going to go and grow our growth, nurture, and strategic accounts, we are well placed to tap into this market further and further.
Yeah, thanks, Sai. I'm sure that will answer your query, right?
Yeah, I understood the landscape. But as a company, how do you see we performing in that landscape?
Sorry to interrupt, sir. May we request you to rejoin the queue as there are several participants waiting for their
Sure. Okay.
Thank you. We have our next question from the line of Part2 from Alpha Plus Capital. Please go ahead.
Hi, sir. Thanks for taking my question. Sir, I have a couple of questions. One, do we have some leading indicator, the growth that supposedly was posted? I would say our expectation would be much higher in terms of the growth that we are posting. So internally, do we have some leading indicators, especially you mentioned core revenue comes from the Western world. So if that could get us some guidance on, companies probably pushing on the order side.
Yes. So in IT services, generally the leading factor is order book. And I did mention earlier that our order book actually continues to be healthy. In terms of our revenue realization from order book actually also continues to be in line with the industry. So if we look at our, Krishnan actually gave this number earlier, and if you look at the multi-year order book and the order book which actually we have currently booked, in last 9 months, that certainly actually continues to demonstrate that we will grow in double digit, in next financial year. So that's all I can tell you right now. As Krishnan mentioned, we don't give any specific guidance, but order book definitely continues to be healthy.
That is certainly helpful, sir. Sir, in terms of the recent client acquisitions that we've made, 6 in the last quarter, 9 in the previous one, are these clients expected to be large billing clients from next year itself, where we could probably see 1 or 2 of those clients creeping into our top 10 client list or top 15 client list?
Absolutely, yes. One of the largest client which we acquired in last 3 quarters is top 3 railroad transportation company in North America. Their spend is minimum 3-digit $1 million, like hundreds of millions of dollars, which they could spend on the technology space. We've actually signed up a sizable deal with them. As we speak, we are transitioning work from some of the larger peers, which actually happens to be an integrated application development support and quality engineering. The other client that actually, which I was referring to, which is a BFSI client, is a bank with about $80 billion of assets under management. They offer, again, they are a client actually which spend a fairly sizable amount in the technology space. So, the retailer which actually I was talking about, that retailer is one of the largest retailer in Eastern European market. As of now, we are absolutely optimistic that some of these clients actually will definitely become our top 10, top 20 customers in the coming financial year.
That is very encouraging, sir. Sir, finally, if I could squeeze in one last question. We've been talking about organic growth, which will help us achieve the long-term target that we've envisioned. Do we have everything on the table while we understand that getting something EPS accretive and the field that we are looking in could be certainly challenging in this environment. But while the growth is a little tepid, if we may say so, do we have certain opportunities on the table as of today?
I think, are you referring to organic growth?
Inorganic growth.
Inorganic growth.
No, so inorganic growth, I think we are very aggressive. Active proposals are being considered, but I think as we get to the stage, invariably, I think we'll get it through by the board and then we'll disseminate the information systematically. But I think I can say that we are very aggressively on the lookout.
Super. That's it from my side. Thanks for taking all my questions, sir.
Okay.
Thank you. We have our next question from the line of Danesh Mistry from Investor First Advisors. Please go ahead.
Hello. Good evening, and thank you very much for taking my question. I actually had just two questions. One is that, obviously you've talked about how you've gotten resources and employees. So you could just run us through, what's happening on the utilization front, especially on the on-site side. That's number one. Number two is, your other expenses have gone up meaningfully, both YOY on quarter. So some sense on what these other expenses are, especially if there are any one-offs. And related to that, you've mentioned certain cost control measures. So how are these linked to this other expenses line item would be helpful to understand. Thank you.
Yeah, thank you. My utilization at on-site is at about 93% or so. It always remains at about 93 to 95, subject to a quarter or two variation by about 1%. My offshore utilization remains at about healthy at about 82%. Mm-hmm. I would say that I've reached the optimal level at this point of time. Mm-hmm. While this 82% will have a marginal impact as we start pushing up, because today the digital is minuscule. Digital operates at about 70-72%, and then probably I'll be able to push it to 75% on the digital side, which is essential to have the resourcing on the jump start. So I would say the utilization is on the optimal effect with respect to where we are today. With respect to the expenditure, if you look at especially on the other expenditure side, which is which you have asked about the increase which has happened invariably, is that one-off line item could be on the legal side, which we had to do certain employee settlements, especially in the quarter. And that is specifically on the line item. But we have gone ahead and we have spent certain marketing dollars on certain events, especially like CIO events and other events invariably. We have utilized the opportunity and created a visibility, especially when we launched on the digital side, which is essential. And added a couple of sales folks, which was necessitated for us, especially creating and carving a niche out on the specific segment of vertical very clearly, which the benefit of it, everything will come through basically even out over the next couple of quarters as we start seeing the generation of the revenue. So apart from these two, in terms of the expenditure on the other side, and there has been some amount of OPEX expenditure which was necessitated on the IT side for certain upgradation of the networking and other security tools, which was based on the worldwide cyber attack happening. We had to necessarily spend and take a precaution on the cyber attack areas. So I think these are one of things which definitely necessitated for enhancement in the expenditure.
Got it. But if you could give a sense around
we are carefully monitoring each and every line item to ensure that either optimization or reduction or to get the best value out of it.
Got it, sir. So, sir, out of this roughly 50 crores, I'm not asking for a breakdown, but out of this 50 crores, how much would be attributable to the three heads that you kind of talked about, roughly?
I would probably take it offline and send you the details very clearly on that, because I will not just remember on the face of it clearly.
Sure.
I know for sure that if you look at for the quarter, at least my EBITDA would have moved up by about 1.25% to 1.3% from the current level, which speaks very clearly as to the volume, as to what it is on the legal front. But I think if I have to assimilate for the 9 months, probably I can take the question offline and send it across to you.
Sure, sir. That would be great. Thank you very much, sir, and wish you the very best of luck. Thank you, sir.
Thank you.
Thank you, sir. We have our next question from the line of Faisal Zubair from HG Hawak and Company. Please go ahead.
What are the kind of customers that we are having, and can you give a flavor of which industries are which industry contributed as to what percentage of our total revenues? That's one. And second is, sir, if you could just guide us about the evolution of this company and also the management structure as to who really looks after what the functions, and if you could guide us with the KRAs of the key personnel like CEO, CMO, and COO also.
So our top three industry segments are retail, BFSI, and HCLS, healthcare and life sciences. These are our top three industry segments, with approximately about 22% coming from retail and e-commerce, approximately almost equivalent or maybe 21.5 coming from BFSI, and about 17-18% coming from travel, transport, hospitality, and about 12-13% coming from HCLS. So those are our four top industry segments. Sorry, actually, I said HCLS is number 3. Actually, HCLS is number 4. Travel transport is number 3 for us. So this, in terms of percentage, that's the industry segment. What was your question regarding the customers?
No, he asked what the KPIs for the K and Veera as to what Veera can look at it.
Okay, Veera, do you want to answer that question?
Sorry, missed question. Can you repeat that, please?
So my question is that what is our management structure, and what are the KRAs for the key personnel like COO, COO, CMO, and CEO?
Okay, so KRA is pretty much directly tagged to the financial goals that we have. We have revenue.
How much of the KRA is tagged to revenue? What percentage?
So it is at the CRO and CDO level. It is 30% of the KRA is tagged to the revenue.
Yeah. See, gentlemen, we are a company. We are a listed company, and we are governed by the board, independent, and we are governed by the budgets, which are necessary as per the internal controls and measures. And the KRAs and KPIs are tagged to these budgets and individual performance parameters, which are monitored by the compensation committee. And it is applicable from level 1 to the level 7 officers clearly. I think just to understand, in this call probably I'll be able to provide this much. Probably anything beyond that, if you have any specific queries with respect to what it is, what is possible for disclosure, we will do it. I appreciate if you can write to us separately. Thank you.
Yeah, if you could just mention it in the next annual report.
Whatever is statutorily required is running through in the annual report. What has been missed out, we will definitely look at it, but to our knowledge, basically, we have not missed out. What is essential and to be furnished as per the Companies Act necessary, we are furnishing, and we shall be more than happy to furnish whatever is needed. Yeah.
Okay, sir. I appreciate you answering my question so well, sir.
Thank you, sir. We have our next question from the line of Mr. Subhash from Value Investments. Please go ahead.
I had two questions. First, on the new deal wins, I think you have answered that. The second question is on the shareholding pattern. So the promoter holding has
your voice is not clear. Your voice is not clear. Can you be a bit audible? Louder, please.
Okay. Are you able to hear me now?
Yeah, perfect.
Okay. So I had two questions. So the first one was on the new deal wins. I think you have already answered that. So my second question is on the shareholding pattern. So the promoter shareholding has been decreasing from last 4 years, if you see. And from the last few quarters, it has been decreasing continuously. So if you could give some light on that, that would be helpful.
Yeah, okay, so it is, you should understand that the business is being run over the last 25 years by the promoters. And the decrease could be on account of various reasons. One is on account of a natural dilution in the initial years, basically on account of preferential issues, but subsequently, if you look through, basically on ESOPs. And the third point now is that they would like to retire with certain of their personal debts, considering their own set of segments in terms of where they are operating. They would like to be a debt-free invariably. So for that purposes, the retirements have taken place. But if you look at it, in between, they've also acquired. But having said that, but I think it's an individual choice for a company, and especially on the technology stack, basically. I think we're more concerned in terms of the going concern, continuity, and movement very clearly. While the promoters portion, what we talked about, is trying to come down, we also have to look at and give weightage to the institution mutual funds, where the holding has moved up by about 7, 8%, 10% close to, including, if you look at the PMS, we are there at about 10%, which has shifted their hands into a healthier hands clearly. But beyond this, I don't think I'll be able to answer very clearly as to what is their reasoning, basically, because it is all their personal reason. But if you look at it, they have not really moved ahead to reduce drastically as to what it is. And if you look at, there is a set of promoter who are holding about 9%, has reclassified themselves as a non-promoter. So if you consider that, still that portion of the stock which we enjoy a good relationship remains as a part of promoter known entity of promoter very clear. It is just that for administrative convenience, he would like to, being NRI, he regrouped himself as a non-promoter. So that has to be grossed up when you compare basically as to what it was. So I would say that reducing by about 5-6% over a period of 15-20 years, it's understandable.
Okay, yeah. The reduction has been like over 8% from last 4 years, but you have answered my question. So I'll look over the details on the non-promoter side also, as you mentioned. Thank you so much.
Yeah. Thank you.
Thank you, sir. We have our next question from the line of Majid Ahmed from Smart Sync Investments. Please go ahead.
Thank you for the opportunity. Am I audible?
Yeah, very much. Please go ahead.
Yes, sir. Sir, why has the pace of new clients have reduced? I think it was at 9 and now it is 6. Do you see that decreasing, or it will get steady and it can move going forward?
No. I will ask my colleague Vinay to answer. Your question is that why new addition of clients has reduced? You are just comparing compared to last quarter to this quarter. But I think I will request my colleague to answer that.
So some of this is actually, intentional. Just to actually tell you that we've been focusing more on the quality of the customers which we acquire. The intent is obviously whatever customer we acquire, those customers actually should have enough spend, which actually can, continue to be an important and strategic, and they actually offer potential to become important and strategic, customers to us. Just to give you a number perspective, our average client size, which actually we acquired last year or prior to that year, that number actually has almost quadrupled. Though the number of clients actually have come down, but the average size of the customer which actually we have acquired has quadrupled. So the quantity is reduced, but the quality has improved substantially. And that's actually been the focus. That's by design, not by accident.
Okay, sir. Sir, then is there any plans in terms of the industry? Are you planning to move to the automotive or EV space? Any plans do you have in providing your services?
Given our size, we have not specifically focused or created domain competency to go after a specific industry segment. Our play is more horizontal, more technology play, and that's what we continue to do. We do believe that I think in the coming quarters or a year or so, we actually should have threshold of revenue, which actually will certainly warrant for domain competency improvement. And at that point of time, we will focus on industry segments